Okay, let's unpack this. I want to start with a statement that should immediately make you maybe check your brokerage app history.
Hmm.
People don't trade stocks anymore. They trade emotion. Let that idea just settle in for a moment because it is far truer and honestly far more disruptive than most people involved in the market really want to admit. The ticker symbol. It used to represent, a somewhat rational measure of a company's underlying value.
Right.
It required you to look at, let's be honest, boring things sometimes.
Mm.
Cash flow, debt ratios, those PE sanity checks.
The fundamentals.
Exactly.
Yeah.
But what we're tracking now, it feels less like a balance sheet and much more like a collective mood ring for the masses.
A mood ring. That's a good way to put it.
It's like a social graph.
Yeah.
Instantly reactive, all wrapped around a flickering candlestick chart.
And that fundamental shift you're describing, that's really the core of what we need to explore in this deep dive today. Look, market mania, the kind driven by pure human irrationality, that's not new. It's ancient history, really.
Yeah, you can point to the tulip bubble.
Absolutely. The 17th century tulip bubble or, the dot-com frenzy back in the late 90s. We've seen this kind of thing before. But what is completely, utterly novel about the current environment is the incredible speed.
The speed?
And the sheer psychological precision involved. Plus, the digital mechanisms that are fueling this emotional market now, it's driven by, real-time neurochemistry, amplified by algorithms, and it's served up instantly right there on your smartphone.
So our mission today, then, is to try and peel back the layers on this really complex system.
Yeah.
We're diving into the sources we've looked at to understand the core psychology of the modern trader, the underlying neuroscience that makes us all so susceptible to this volatility.
And the social drivers, too.
Oh, absolutely.
Hello, meme stocks.
Can't ignore those.
And crucially, we need to look at the surprising scientific evidence that's emerging about market causality.
That's a big one.
We really need to know. Are we fundamentally driving the prices with our collective mood, or are the prices actually determining our mood? It's a chicken and egg thing. Exactly. And this isn't just academic. This is about giving you, the listener, a crucial shortcut. You really need to understand these powerful psychological forces that are shaping today's investing decisions. And maybe even more importantly, the specific forces influencing your own finger when you're hovering over that buy or sell button.
Yeah.
We're trying to move past the usual market commentary here and actually look at the wiring inside your brain.
Okay, let's start with that shift we mentioned, section
Sure.
1. The new emotional casino, dopamine and the rush.
Right.
Investing used to be work, didn't it? I mean, it demanded disciplined research.
Patience was key.
So much patience. You needed the time to wait for a return that might be 5, maybe 10 years away.
Right. Long-term thinking.
Now, the market seems to have completely inverted that whole formula. We're seeing a system that fundamentally seeks dopamine, not steady dividends.
It really is the ultimate emotional casino environment. I mean, just look at the language people use now.
Bro trading.
Bro trading, FOMO trading, the sheer excitement whipped up by meme stocks, by SPACs, by crypto surges.
Yeah.
The energy isn't driven by the quality of the underlying asset anymore, is it? It's driven purely by the adrenaline of the trade itself.
And if you really analyze the business models
Yeah.
of the most successful, maybe addictive industries over the last, say, 20 years, Vegas, gaming, social media platforms, they all perfected the art of monetizing human compulsion.
Mm-hmm.
And they all understand the incredible power of the intermittent reward.
And our sources draw a really clear and frankly slightly chilling parallel here.
Which is?
Trading today mirrors the specific circuitry of addiction, particularly the slot machine.
The slot machine, that pull the lever feeling.
That's the crucial insight into why we get hooked so easily. See, successful professional trading is supposed to be about the meticulous execution of a predetermined edge.
Right, having a plan.
Having a plan and often requiring long periods of just waiting. Boring waiting.
Yeah, patience again.
Yeah. But addictive amateur trading. That's the frantic pursuit of a specific feeling, a rush. When a green candle pops up on the screen and a trader realizes a profit, their brain gets this massive, sudden hit of dopamine.
The reward chemical.
Exactly. This triggers euphoria, that sense of being a financial genius.
I've felt that.
We all have, and it triggers a potent feeling of urgency, this immediate need to repeat the action right away.
Your brain is basically just shouting, more, do it again, now.
Precisely. But here's the problem with dopamine. Unlike, say, serotonin or other neurotransmitters, it's metabolized incredibly rapidly.
So the high is short-lived.
Very short-lived. The high crashes quickly. And when the trade is over, or even when the market is just slow, moving sideways, The trader falls into this vacuum. Our sources define this as a really dangerous state of boredom.
Boredom. It sounds so mundane, but you're saying it's actually the quiet killer of trading accounts.
It absolutely is. Because if you're wired to chase that high, a dull market day feels intolerable. You need a fix, regardless of whether a genuinely good trade setup actually exists or not.
You manufacture the action.
Exactly. That boredom state is fundamentally where the undisciplined trader hemorrhages money. They ignore the high-quality, patient setups because those require waiting, and waiting is the absolute antithesis of the dopamine chase.
So what do they do instead?
Instead, the trader seeks that missing excitement through what we call impulsive actions. Or worse, the highly destructive revenge trade trying to instantly win back money you just lost.
Been there. Doesn't usually end well.
Rarely. Or greed trades, where they suddenly over-leverage after a win, thinking they finally cracked the market code.
Yeah.
In all these cases, they're looking for the spike, that dopamine rush, not the steady, consistent extraction of their actual trading edge.
And what makes this so uniquely modern, so pervasive now, is that this whole environment isn't some accident of technology.
No, not at all.
The sources really emphasize that the technology itself, the platforms, are intentionally designed for compulsion.
Absolutely. Think about the brokerage apps themselves. They're slick, they're fast, they offer instant gratification.
Little flashing lights, leaderboards.
Celebratory graphics when you profit, exactly. They are functionally engineered like dating apps or mobile games.
Swipe. Match.
Swipe, match, and in this case, you get leverage access, all designed to minimize any friction between the initial impulse and the final execution of the trade.
Click. Boom, you're in.
And this design is insidious, really, because it actively trains a whole generation to be, as one source put it, illiterate in patience.
Wow, illiterate in patience.
They might become fluent in reading incredibly complex technical charts, candlestick patterns, indicators.
Yeah, they know the jargon.
But they are fundamentally unable to just wait, to sit on their hands when the conditions aren't right.
So they aren't true investors guided by underlying value.
No, they're mood surfers, as the source called them, reacting instantly to every tiny fluctuation, trapped in this constant state of neurological reactivity.
I have to admit, I know this feeling personally really well. I remember a period where I was checking stock prices multiple times a minute.
Compulsive checking.
Even when I knew, logically, nothing fundamental had changed in the company or the economy, but that thrill when the number ticked up.
A little dopamine hit.
Yeah. And that instant pit in your stomach when it dropped. I eventually realized I wasn't waiting for dividend payment or long-term growth. I was waiting for the next neurochemical rush.
And the system, the market structure, the app design, it doesn't just tolerate this confusion between disciplined investing and compulsive gambling.
It profits from it, massively.
That profit margin is entirely built upon your lack of emotional control.
So disentangling that neurological loop, understanding it, that's got to be the necessary first step towards achieving any kind of consistent success.
It has to be, because emotional trading, chasing the rush, almost inevitably leads to outcomes we all universally dread. Excessive losses, blown accounts, and
The wiring. Section 2, the neuroscience of financial decisions.
right. To truly gain control, we have to move beyond just talking about the rush vaguely and look at the specific machinery inside your skull. When a financial decision is being made, there are essentially two parts of your brain that are almost always in conflict, or at least in conversation.
Okay, what are they?
First, you have what we can call the logical brain. This is your highly evolved prefrontal cortex, the PFC, sitting right behind your forehead.
The smart part.
The sophisticated CEO, let's say. It handles complex cognitive thinking, logical reasoning, mathematical calculations. It's where your fundamental analysis should be originating.
That's the part of the brain that's supposed to say, hang on, this stock's PE ratio is 400. That doesn't really make sense long term.
Precisely. It's the regulator, the voice of reason. Then, deeper inside, you have the emotional brain. This is primarily the limbic system.
Older, more prevalent.
Much older, evolutionarily speaking. It's a deep, sort of U-shaped, ancient structure that controls pretty much every primal emotion we feel. Happiness, fear, distress, anxiety, frustration.
The raw feelings.
Think of it as the highly reactive security guard, or maybe the building's alarm system, always scanning for threats or rewards.
You know, I find it endlessly fascinating that even today, we still talk about emotions coming from the heart. or that gut feeling.
It's a very common romantic idea, isn't it? But physiologically, it's just inaccurate.
So the heart racing is a symptom, not the cause.
Exactly. Your heart rate variability, that fluttery feeling, that's a consequence of the brain's emotional signals originating in the limbic system. The decision to feel fear or excitement originates entirely in the brain, specifically that limbic system. And crucially, when the limbic system gets highly engaged when that security alarm goes off, it can actively suppress the logic of the PFC.
So emotion overrides reason.
It can hijack it, essentially,
Yeah.
leading the rational part of your brain to make mistakes or to rationalize decisions that are actually driven by fear or greed.
Okay, let's zoom in then on the specific emotional control centers that get fired up when we trade. You mentioned the alarm system that's anchored by the amygdala.
The amygdala, yes. It's this tiny almond-shaped organ nestled within the limbic system. It acts as the primary hub for processing fear, anxiety, and panic.
The fear center.
That's a good way to think of it. And our sources highlight something interesting here. Investors who are genetically predisposed to have a highly activated amygdala.
Meaning they're just naturally more anxious or reactive.
Exactly. They tend to make more defensive, sometimes even suboptimal decisions in the market. They consistently act out of stress, even when the underlying market conditions are fundamentally sound. They're sort of biologically wired for a heightened stress response in these situations.
Okay, so when that dopamine hits, like we talked about in section 1, after a profitable trade, how does that interact with this fear center, the amygdala?
This is the genius, or maybe the danger, of the addictive loop. When dopamine is released because of a profit,
Yeah.
the fear response in the amygdala actually goes down. It gets suppressed temporarily.
So the profit literally makes you less afraid.
Momentarily, yes. And that momentary suppression of fear is part of the reward. It's what makes that impulsive action, that quick follow-up trade, feel so good and seemingly safe at the time.
Right, you feel like you're operating without fear, like you're invincible.
Which then encourages you to take bigger risks immediately after a win, when your judgment might actually be impaired by the dopamine itself.
Wow. But then there's the flip side, the loss. And the research on this is really, really important for listeners to internalize, I think.
Absolutely critical.
When we incur a financial loss, it apparently activates the very same brain organs that respond to actual physical injury.
That's exactly right. We are talking about specific regions.
Yeah.
The anterior cingulate cortex and the anterior
And
insula.
these are normally associated with,
These are the regions responsible for processing physical pain, like if you touch a hot stove or stub your toe or sustain a more serious injury.
so there isn't some separate financial loss center in the brain.
No, none whatsoever. When you lose money, the brain processes that event using the same circuitry it uses for actual physical harm.
Which explains why losses feel so viscerally awful.
It's why financial loss is so destabilizing and causes such a profound, almost physical response in traders. It is not just metaphorical pain. Neurochemically, it is perceived by the brain as akin to injury.
That reframes the whole pursuit of profit, doesn't it? It's not just the desire for wealth, but maybe an unconscious attempt to avoid this deep-seated physical-like distress.
It certainly adds another layer to the motivation, yes.
Okay, so let's trace that full reward system again to the listener, that really compelling physiological loop that basically compels us to chase the next profit. You called it the dopamine mine circuit earlier.
Understanding this specific pathway is absolutely key if you want to gain self-control over impulsive trading. Think of it like a 5-step assembly line designed for compulsion.
Okay. Step 1.
It all starts at the ventral tegmental area, or VTA. We can call this the secretor.
The secretor, got it.
It's an area rich in dopamine neurons. And when you achieve that profit, that's where the dopamine cascade begins. Big release.
Step 2.
From the VTA, the dopamine travels immediately to the amygdala, which we already established as the alarm system or fear center.
Right.
The dopamine surge tells the amygdala essentially, stand down. The fear alarm temporarily goes silent. The brain interprets this as, this action is good. Keep doing it.
So the brain is actively removing caution signal.
Exactly. It's lowering your natural risk aversion. Step 3 is crucial. The dopamine hits the nucleus accumbens. Let's call this the urge generator.
The urge generator, I like that.
This area is strongly stimulated by the dopamine flood. It controls that feeling of reward, that yes feeling, but critically, it also governs motor functions. So it makes you want to do something.
Precisely. This is the part that creates the overwhelming physical impulse. The literal urge to repeat the action, to trade more, maybe increase your position size, or rush into the next potential setup without proper analysis.
Okay, what's step 4?
Next, the signal moves up to the prefrontal cortex, PFC, which we called the CEO earlier.
The rational brain.
But now the CEO is, shall we say, compromised by the dopamine influence. Instead of coolly regulating logic and risk, the PFC's attention becomes intensely focused on how to repeat the success. It starts optimizing the mechanics of the trade that just provided that pleasurable rush.
So it's planning the next hit, not evaluating overall strategy.
In a way, yes.
Huh?
And finally, step 5. The signal reaches the hippocampus. We can call this the memory maker.
Okay.
The hippocampus creates a powerful positive memory trace associated with the entire process. The trigger, the action, the reward, the feeling.
So it locks it in. This complete circuit effectively closes the loop. It binds the feeling of profit not just to the abstract concept of money, but to that physiological rush, that temporary silencing of fear, that urge to act. It ensures the individual will seek out that sequence again and again, almost automatically, regardless of the actual quality or risk of the subsequent trade. It becomes a learned, compulsive behavior.
Wow. Okay, so that dopamine loop, it becomes exponentially more powerful, I imagine, when it's amplified by the crowd.
Oh, massively.
Which brings us neatly to section 3. Meme stock psychology in the herd.
Yeah.
The rise of meme stocks, GameStop, AMC, Dogecoin, all those feels like the purest, maybe the most chaotic reflection of this collective emotional engine running completely wild in the modern digital age.
It really is. Meme stocks generally don't trade on traditional metrics, do they? Things like cash flow, management efficacy, market share.
No, not really. It's
But-
all about the narrative, the hype.
Exactly. They sell a different, much more intoxicating product.
Yeah.
The desire for instant, life-changing wealth.
The lottery ticket effect.
Precisely. They are the perfect exploitation vehicle for FOMO, that intense fear of missing out, which, as we know, can completely override any logical assessment of risk or underlying value.
And when you look at the psychological profile of the typical meme stock trader, based on the research, what patterns do the sources tend to highlight?
Well, they're overwhelmingly characterized by a significantly high appetite for risk. They often view trading less as a form of long-term investment and more as a form of highly engaging, exciting gambling.
More like the casino we talked about.
Very much so. Their decisions tend to be impulsive, driven largely by instant online trends, social media buzz, and viral hype, rather than, say, deep due diligence or fundamental analysis.
And the strategies are short-term.
Inherently short-term, yes, often designed explicitly to catch the pump, ride the momentum wave, and get out before the inevitable dump. It's not usually about holding for long-term value creation, and they rely incredibly heavily on social proof.
Meaning looking to others to see what to do.
Exactly. Undecided traders, or those feeling anxious, flood platforms like Reddit, particularly subreddits like Wall Street Bets or X, formerly Twitter, actively seeking validation for their trades or ideas.
Safety in numbers. Even if the numbers are all doing something risky?
That's the illusion, yes. This herd behavior creates a false but very intoxicating sense of security. It's based on the flawed notion that the group's collective momentum, the sheer volume of people buying, must mean the trade is correct or somehow infallible. It makes incredibly high-risk decisions feel safer than they are.
And the scary part, as you mentioned the neuroscience, is that we seem to be biologically predisposed to follow the herd. It's not just a conscious choice to follow a trend. There's a physiological mechanism actually driving this mass imitation.
That's right. That mechanism involves the activation of our mirror neurons.
Mirror neurons, tell us about those.
Mirror neurons are brain cells that fire both when we perform an action and when we observe someone else performing the same action. They're fundamental to learning, empathy, and social behavior.
So when we see others doing something,
When there is mass visible imitation, millions of people online talking about rushing to buy a particular stock or crypto token, posting their gains, those mirror neurons fire in our own brains.
and that makes us want to do it too.
It makes individuals unconsciously, almost automatically, adopt the group's actions. It's essentially a neurological short circuit that promotes conformity. It can effectively override the rational thinking part of our brain, the PFC, with the urgent motor functions driven by the urge generator, the nucleus accumbens, and the social pressure. Everyone's doing it, I should too.
We really need to look at the consequences when this kind of emotional frenzy completely ignores fundamental reality. Let's take a closer look at the Yes Bank crisis in India back in 2020. It seems like a perfect textbook case of this.
It really is a stark example. The bank, Yes Bank, was fundamentally struggling. Its core problem was exponentially rising non-performing assets, or NPAs.
And NPAs are basically.
Bad debt, loans that the borrowers simply aren't paying back. These bad loans sit on the bank's books like dead weight, eroding its financial health and stability.
And how bad was it for Yes Bank?
The sources show that Yes Bank's gross NPAs exploded dramatically. They went from less than 0.5% back in 2015 to roughly 17% by early 2020.
17%. That's huge.
It's enormous. That signals deep foundational rot within the loan book. It turned out they had been aggressively lending to fragile, high-risk corporate borrowers who couldn't repay.
Okay, so the fundamentals were clearly deteriorating badly. Yet many retail investors, especially in the early phases of the panic, were reportedly performing technical analysis.
That's right. They were looking at the charts, seeing temporary price bounces, or following simplistic rules like the trend is your friend, while largely ignoring the fundamental collapse happening underneath.
Focusing on the symptom, not the disease.
Precisely. And when the panic truly accelerated, triggered notably by the Reserve Bank of India imposing a strict withdrawal limit, the subsequent mass selling wasn't driven by a sudden collective understanding of the bank's terrible balance sheet.
No. What drove it then?
It was driven largely by imitation, fear. Everyone saw everyone else selling, their mirror neurons fired, and it triggered widespread panic selling based on social cues, not rational analysis. The stock plummeted because the emotional engine of the herd took over and logical assessment was simply left behind.
And thinking about this specific demographic often involved in these meme stock frenzies, the sort of social retail investors, the pain of loss for them isn't just physical, as we discussed, but it seems to be severely amplified.
Yes, the research here is quite striking.
I saw one source suggesting that for this group, incurring a financial loss is felt roughly twice as painfully as it is for professional institutional traders. Losing $1 effectively feels like losing $4.
That extreme loss aversion is directly connected to a well-established concept in behavioral economics known as prospect theory. But the sources suggest there's a deeper layer here too.
What's that?
This intense pain might also be rooted in a broader sociological reality. A pervasive fear among many retail investors of never being able to catch up financially, feeling left behind by a global economy that seems rigged against them.
So feeling like they're already behind makes losses feel even worse.
It can. When people feel substantially behind, maybe they're saddled with student debt or their retirement goals seem impossibly far off, they are often psychologically driven to increase their risk-taking dramatically.
Why?
Because a small, disciplined game doesn't feel like enough. It won't change their life fast enough. They become focused on seeking that one large, life-changing gain, the moonshot.
The meme stock dream.
Exactly. This desperate pursuit for a quick, massive win fuels the speculative frenzy around things like meme stocks and highly volatile assets. And it, in turn, amplifies the market volatility itself, creating these boom and bust cycles driven by hope and fear.
Okay, this brings us to what you called the most scientifically provocative portion of this whole deep dive. Section 4. Causality. Does emotion drive price, or does price drive emotion?
Right. This is where we challenge some long-held assumptions. For decades, you've had giants of finance, think Alan Greenspan warning Congress about irrational exuberance.
Right, back in the dot-com bubble.
Or Warren Buffett famously advising us to be greedy when others are fearful and fearful when others are greedy. The underlying assertion in all of this has always been that emotions cause market behavior. Irrational feelings drive prices up or down.
That seems intuitive, doesn't it?
It does seem intuitive, but recent laboratory experiments using controlled settings allow us to actually test the direction of that causality in a more rigorous way.
So we have to ask the core question again. Is the market surging today because I happen to wake up feeling really jovial and optimistic? Or am I feeling jovial and optimistic precisely because the market just handed me a massive profit on my trades?
It sounds like a subtle, almost academic distinction, perhaps.
But the difference is huge. It dictates how we should approach trading, regulation, everything.
It dictates everything. So researchers designed experiments to isolate this. One key approach was what they called the incidental emotions test.
Incidental emotions, meaning emotions unrelated to the market itself.
Exactly. They induced specific, External emotions, happy, fearful, or neutral in participants using validated techniques like showing them specific VR videos before these participants were allowed to execute any trades in a simulated controlled market environment.
Okay, so they prime them emotionally first.
Correct. They wanted to see if that pre-existing external mood, the incidental emotion, would then cause a measurable change in market outcomes like price levels, trading volume, or the individual tendency to buy versus sell shares.
And what did they find? Did a happy mood make the market go up?
Here's the really counterintuitive finding, the one that challenges that traditional wisdom from figures like Greenspan.
Okay.
The pre-existing or incidental emotions, the induced joviality or the induced fear, did not significantly affect those key market indicators.
Wait, really? So my general mood when I sit down to trade doesn't actually impact the market overall.
According to these specific controlled experiments, not in a reliably causal way that affects aggregate market prices or volume, we cannot reliably conclude, based on this evidence, that simply waking up on the wrong side of the bed is going to dictate broader market movements.
Huh. That challenges a huge amount of popular trading advice, doesn't it? All this stuff about mindset coaching being the absolute key to navigating market volatility. Is that potentially misplaced? Or is there maybe a deeper level of emotion we need to consider?
That's the absolutely critical distinction the research makes. It suggests that while your incidental emotions, your general moods, certainly exist and affect you personally, the powerful structure and mechanisms of the market itself might be too robust, too complex, to be significantly swayed by one individual's pre-existing general feeling.
Okay, so my baseline mood doesn't drive the market. What did they test next?
So then they flipped the script. They ran what's called the integral emotions test.
Integral emotions.
Yes. Instead of inducing an emotion beforehand, they focused on measuring the change in the trader's emotional state after the market activity took place. They tracked self-reported levels of joviality and fear from the beginning to the end of the trading session.
So looking at how the market affected their feelings.
Precisely. Investigating the reverse direction of causality.
And here, I'm guessing the relationship was pretty undeniable.
Strong, clear, and definitive. Result number 2 confirmed that market outcomes, what actually happens during trading, significantly affect the trader's subsequent emotions.
In what way?
Specifically, higher individual earnings within the experiment were powerfully associated with a measurable increase in reported joviality and simultaneously a sharp decrease in reported fear.
So making money makes you happy and less scared. Losing money, presumably the opposite.
Exactly. The market activity itself, the profits generated, the losses incurred, even just the excitement of the volatility is what reliably creates the dominant emotional state in that context. The market produces the emotion more reliably than pre-existing emotion produces the market outcome.
Okay, this leads us to that crucial difference you mentioned between incidental emotions, like my general mood or the weather outside, and integral emotions.
Yes. Integral emotions are the feelings experienced at the time of decision-making, feelings that are directly tied to the potential or actual outcome of the trade itself, the excitement of a potential win, the anxiety about a potential loss, the panic during a crash.
So the profits and losses generate these integral emotions.
Correct. And those integral emotions then powerfully drive the next set of decisions. It becomes a self-feeding loop, generated and perpetuated by the structure and outcomes of the market itself.
Now, trying to measure these integral emotions in the real world, outside the lab, seems tricky. But the sources introduce a fascinating quantitative tool for this, called the Market Emotion Index, or MEI. How on earth do they capture that from the real market?
It's actually a brilliant application of large-scale textual analysis. Researchers essentially scrape millions and millions of news articles, both specific financial news sources and broader national news narrative.
Okay.
And they use algorithms to track the high-frequency word counts associated with excitement, words like surge, boom, gain, rally, minus the word counts associated with anxiety, words like fear, crisis, loss, panic, relative to the total number of emotion-related words found.
Wow, so it's quantifying the emotional tone of the news coverage.
Exactly. It provides a measurable, quantifiable proxy for the prevailing integral emotion that's being expressed and consumed, tied directly to market events and coverage.
So if the headlines are suddenly filled with phrases like historic surge, unprecedented gains, and fewer words like caution urged or panic selling, the MEI would spike upwards.
That's precisely how it works. And the most compelling finding from this research is the MEI's significant predictive power.
Predictive. How so?
They developed a metric called the integral emotion beta, symbolized as beta MEI, which measures how sensitive an individual stock's price is to shifts in this collective market excitement or anxiety as captured by the news sentiment.
So some stocks react more strongly to emotional news than others.
Exactly, and they found that this beta MEI is a statistically significant predictor of that stock's future returns.
You kidding? So the market's current emotional reaction to a stock, reflected in the news, actually helps predict where that stock's price will go later.
Yes. And remarkably, this predictive ability holds true even months into the future. The studies suggest potentially up to 8 months ahead in some cases.
8 months. That's incredible.
It is. Stocks that are highly sensitive to this market excitement or anxiety news, those with a high beta MEI, often tend to earn higher future returns, controlling for other standard risk factors.
So the initial euphoria, or panic, which is generated by market outcomes and then amplified through the news narrative, that actually signals future performance.
It seems to. It means that while your personal mood when you woke up this morning might not matter much for the overall market, the aggregated integral market mood, reflected and amplified by the media, is actually a highly valuable, albeit noisy and chaotic predictor of future movements. Emotion created by the market predicts the future market.
Which brings us directly to Section 5, the digital fingerprint, social media and market volatility. Because if the market itself is the engine driving these powerful integral emotions, then social media has become the high-octane fuel injector and, frankly, the super spreader.
That's a very apt analogy.
It allows this ultra-high-frequency sentiment data, people's instant reactions, opinions, fears, excitement, to be generated, aggregated, and analyzed in practically real time.
And it doesn't just reflect the sentiment, it rapidly disseminates information and misinformation and instantly amplifies that collective feeling, whether it's euphoria or panic.
So social media doesn't just mirror market volatility.
No, it actively accelerates and arguably increases it. The studies looking at this demonstrate a really powerful correlation between social media sentiment and subsequent market volatility.
How do they measure that social mood?
One example is the Social Mood on Economy Index, SMEI. This index is derived from analyzing the text content of millions of posts on platforms like Twitter, now X, focusing specifically on economic sentiment. It provides near real-time data on the public's financial mood.
And what's the observable relationship between, say, a negative spike in that online mood and actual market chaos?
It's quite direct. During periods of high stress, the clearest recent example being the initial shock phase of the COVID-19 pandemic in early 2020.
Right. Huge uncertainty then.
Exactly. Studies showed that sharp negative peaks in the social media sentiment indices almost always corresponded precisely or even slightly led positive peaks in standard market volatility measures, like the VIX index.
So when the collective online mood turns fearful or negative, market uncertainty, measured by how much prices are swinging around, increases dramatically and almost instantaneously.
The connection is very rapid and very strong.
Yeah. The most dramatic, almost unbelievable case study we have of this digital influence turning online sentiment into real-world market action has got to be the GameStop short squeeze saga.
Oh, absolutely. GameStop, or GME, was a perfect storm of social coordination driven almost entirely by integral emotion and amplified online.
What happened there, just briefly?
You had this massive surge in positive sentiment and collective energy, primarily organized and amplified on platforms like Reddit's Wall Street Bets forum. This rapidly coordinated a huge retail buying effort, specifically targeting stocks like GME that were heavily shorted by professional hedge funds.
So it's David versus Goliath, fueled by online hype.
That was the narrative, yes. And social media was the primary mechanism, the organizing tool, and the amplifier that led to that dramatic, incredibly swift increase in GME's price and the resulting extreme volatility. It famously caught several large, fundamentally focused hedge funds completely off guard, forcing them into massive losses.
And the speed of it all?
The speed of the emotional amplification, the memification of the stock, was completely unprecedented at that scale. And it's not just about mass movements. Social media also amplifies the voice and influence of the single prominent influencer to an extraordinary degree.
You mean like specific CEOs or public figures?
Exactly. We see a strong and readily observable correlation between sentiment generated by individual public figures, particularly someone like Elon Musk, for instance, and subsequent stock price movements.
Especially in stocks they're associated with, like Tesla or cryptocurrencies they mentioned.
Precisely. Sentiment shifts observed on social media following their communications, like tweets, often precede actual stock price movements. This demonstrates again that the emotional narrative being spun, rather than just objective data or fundamentals, is often driving short-term market behavior, especially in highly visible assets.
So social media acts as this ultimate feedback loop multiplier then.
That's a perfect description. Positive sentiment generates buzz, encourages more buying, which pushes prices up, generating more excitement, more positive sentiment, a virtuous cycle until it isn't.
And the flip side.
Negative sentiment spreads just as fast, exacerbating downturns, driving widespread fear, triggering margin calls, and leading to mass selling. The fear feeds on itself.
The digital platforms essentially just accelerate and magnify the core collective investor psychology, the FOMO, the panic, the herd behavior that we discussed earlier with mirror neurons.
Exactly. They make the emotional swings faster, louder, and significantly more volatile than they might have been in the pre-digital era. They can turn relatively minor fluctuations into major market events based almost purely on synchronized, amplified sentiment.
Okay, so if the market really is this psychological minefield,
Yeah.
a place where our brain's reward circuits get hijacked, where profits and losses feel like physical pleasure and pain, and where social pressure amplifies everything.
Yeah, it sounds pretty daunting when you lay it all out.
It does. Then success, real, consistent success, seems to require a complete abandonment of the old playbook, doesn't it?
Absolutely. You cannot approach this environment effectively by relying on the traditional hard work success formula that might serve you well in other areas of life.
Why not? Isn't hard work always good?
That formula works well in deterministic environments, where your effort reliably leads to a predictable, fixed outcome. If you study harder for a test, you'll likely get a better grade. If you practice piano more, you'll play better.
Makes sense.
But the market is inherently probabilistic, not deterministic. There's always an element of randomness, of unpredictability. Simply working harder, staring at charts for 16 hours a day doesn't guarantee a winning trade. In fact, it might just guarantee burnout and lead to more impulsive, fatigue-driven trading mistakes.
So what's the alternative?
Success in this environment requires mastering the mind that manages the probability. It's about emotional regulation, discipline, and sticking to your statistically validated edge.
Okay, so how do we cultivate that mindset? The mindset of the apex trader, perhaps. Our sources gave us a really powerful, memorable analogy for this. The cougar.
Ah, yes, the cougar analogy. I like that one too.
Tell us about it.
The cougar is the definition of an apex predator, right? It's patiently, often high up in a tree, sometimes for hours, just waiting and observing.
Not chasing everything that moves.
Exactly. It doesn't rely on brute force or frantic chasing. It relies on deep pattern recognition and extreme discipline. It waits for its prey, like the white-tailed deer, to fall into a predictable pattern, to make a mistake, to present the lowest risk opportunity. And when that precise moment arrives to execute the hunt, the execution is disciplined, it's swift, and as the source material powerfully states, it carries no danger at all for the cougar itself because the setup is perfect.
So trading needs that same kind of patience.
It demands the same patient, disciplined execution of predefined rules, your trading plan, your edge to extract profits consistently from the market's probabilities, rather than constantly rushing for that next dopamine hit or reacting emotionally to every price tick.
It's a shift in focus then, away from the immediate goal of making money on this trade, towards the process and performance of executing your plan correctly over many trades.
That's the professional mindset, yes. Process over outcome in the short term.
Okay, so let's get really practical. What are the daily strategies, the tangible things our listeners can adopt to achieve this kind of emotional control and stop, trading on tilt after a loss or a big win?
The first, absolutely non-negotiable step is developing deep self-awareness. You must build the skill of periodically stepping back mentally to observe your own physical and emotional state.
Like taking your temperature.
Exactly. Taking your emotional temperature, as one source puts it. Think of it like checking the rev counter on a performance car. You don't want to be constantly redlining emotionally.
And this means acknowledging the feelings, not squashing them.
Crucially, yes. You have to acknowledge the anger after a loss, the frustration of a missed opportunity, the fear during volatility. Without trying to suppress or ignore those feelings, you cannot change the fact that you feel angry about losing money, but simply acknowledging, okay, I feel angry right now, is the vital first step toward controlling the action that follows that feeling.
That acknowledgement creates a pause, doesn't it?
Yeah.
It breaks that immediate chain of stimulus response, that compulsion.
Precisely. That pause is everything. The next practical step flows directly from that. You must deliberately recognize the flow.
Recognize the flow.
You need to map out your personal negative behavior sequence. For most impulsive traders, it's almost always the same predictable 3 steps. First, there's a trigger.
Like a losing trade, or seeing a stock you didn't buy suddenly surge.
Yes, or maybe a sudden spike in market volatility, or even just boredom. That trigger leads inevitably to an emotional response.
Anger, disappointment, anxiety, maybe greed after a win.
Exactly. And that emotional response then leads directly, almost automatically if you're not aware, to a negative action.
Like overtrading, chasing losses, rushing into a poor setup, taking way too much risk, hitting the buy or sell button just for that dopamine fix.
All of those. Breaking this destructive flow requires consciously stopping yourself firmly between the emotional response and the detrimental action. You feel the anger rise. Okay? Pause. Step away from the screen, even if it's just for 5 minutes. Breathe. Recenter before acting.
And since we've established that the core neurochemical issue is often the chase for that dopamine rush, then actively managing the physical mechanisms of the brain through deliberate dopamine control must be absolutely central to this whole strategy, right?
It has to be. Successful, disciplined traders learn to control their dopamine exposure. They don't constantly chase the next hit. This means you almost certainly need to implement a strict low dopamine morning routine.
Low dopamine morning, what does that look like?
It means intentionally removing the high stimulus inputs that overload your brain's reward pathways before you even start your trading day or your important work.
So no phone scrolling first thing.
Definitely no mindless phone scrolling, no immediate checking of social media feeds, no chugging high caffeine energy drinks right before the market opens, and crucially, no consuming market hype or frantic news reports just before the session begins. You want to start calm.
Okay, so what do you do instead?
You intentionally substitute planned low dopamine activities. Things like deep reading, a physical book is often better, meditation or mindfulness practice, structured breathwork exercises, or perhaps journaling your trade plan and potential setups for the day.
The goal is to start centered.
Exactly. This ensures you are calm, centered, and focused when the market opens or when you start your analysis. It allows the PFC, your rational CEO brain, to be firmly in charge, not the impulsive nucleus accumbens, the urge generator, driven by external stimuli.
And what about the fun stuff, the high dopamine activities?
You save those for later. The key is to consciously shift those high dopamine activities, maybe intense gaming, binge-watching exciting shows, even very aggressive exercise routines to the evening after the important, focused, productive work is finished.
So you sequence your day for optimal focus.
Precisely. This intentional sequencing helps maintain a more balanced level emotional state throughout the trading day. It helps you avoid those massive emotional spikes followed by energy crashes that inevitably drain your focus and lead directly to impulsive, poor decisions.
And the really good news in all of this neuroscience stuff is that the brain isn't fixed, right? We can actually retrain ourselves. The concept of neuroplasticity.
That's the key takeaway for genuine empowerment here, absolutely. The brain is constantly adapting based on our experiences and deliberate practice. It's plastic.
So we can build better habits.
Yes. Learning new mental skills like emotional regulation, disciplined patience, or sticking to a trading plan structurally builds new neural pathways in your brain. This isn't just metaphorical, it's physical change.
How do we reinforce that?
Consistent self-review is the engine of neuroplasticity in this context. Things like meticulously journaling your trades, but also noting your emotions during the trade. Tracking physical signs. Did you feel tension in your shoulders? Was your breathing shallow? Alongside your trade log.
Connecting the physical, emotional, and financial.
Exactly. This systematic process helps you identify your recurring emotional triggers and bad habits. It allows you to consciously adjust your trading plan and your execution process to counteract them. This diligence builds genuine mental resilience over time. It allows you to learn constructively from losses rather than being derailed by them, and helps you maintain that cougar's focused patience even during periods of high market volatility.
So the ultimate goal is to fundamentally change your internal formula, moving away from one of compulsive emotional reaction.
Towards one of disciplined, successful probability management, building the brain of an apex trader piece by piece.
Okay, let's try and bring this all together as we wrap up.
Right. If we synthesize the science we've discussed and the strategies we've outlined, the central scientific finding really must remain your most potent insight. Remember this: incidental emotions, your general mood when you start the day, they don't seem to reliably cause aggregate market moves. But market outcomes, your profits and losses. The volatility itself, They absolutely create powerful integral emotions. And those resulting integral emotions, the ones quantified by things like the beta MEI from news sentiment, then strongly predict future market performance.
So we're caught in this volatile loop. Market action creates emotion, which then influences future action and prediction.
It's a feedback loop of action, reaction, emotion, and compulsion, constantly churning.
And the whole system seems almost perfectly engineered for this, doesn't it? The market isn't just reacting to objective news anymore. It's reacting, often instantly, to the emotionally charged narrative surrounding the news,
A narrative that is amplified and spread instantaneously by social media platforms.
and often accessed through brokerage apps that, as we discussed, seem intentionally designed specifically for compulsion, for minimizing the friction between urge and action.
It's a confluence of factors.
It feels like our entire modern financial ecosystem profits profoundly from blurring the lines, from exploiting the confusion between disciplined, patient investing and high-stakes, dopamine-chasing gambling.
The incentives often favor activity and volatility over patience and fundamentals, especially in the short term.
So now that you, our listener, are armed with a better understanding of the neuroscience, the psychology of addiction, the social dynamics, and the actual scientific evidence about causality, we want to leave you with one final, really essential question for your own reflection. If the financial system often profits from this confusion between gambling and investing, what is your personal price for that confusion? Are you trading? Are you investing with the calm, disciplined, apex predator mind that you have consciously worked to build? Or are you, perhaps without realizing it, still just chasing the next fleeting, ultimately unsatisfying dopamine hit?